Hello, my trading warrior brothers and sisters. How's everyone doing? Doing all right? I want to welcome our viewers at investing.com. Shahab, how are you? So here we are sitting at the 200-day moving average on the daily S&P chart. You have a low confluence with an uptrend line that goes back to this low. So back under the throwover line, which isn't a good sign. But I'll tell you what, there's going to be a lot of people freaking out if we start trading back underneath the 200-day. You can see we haven't had a touch on the 200-day going back to October of 2019. So, you know, we're talking about 6-8 months since we've regressed to the mean of the 200. I think it's very important. I would venture to guess, here's where we closed Friday. And I was bearish and I was looking for a correction, and I even said, you know, 5 to 10%, thought it'd be compressed in time. But as I have witnessed it this day, the impulsive nature of it even surprised me a bit, that there really hasn't even been any kind of decent rally, you know, attempted a rally here. But I think this is very important here. How are you, David? Kaylee, nice to meet you. Hi, Sinatra. Okay, so if we're going to get some type of reflex rally here, I'm finally betting on crude with the $1 stop from here. Looks pretty ugly, doesn't it? Okay, that's your daily. There's your 4-hour. I have no divergence. So I'm asking myself, why am I doing it? I have a little bit in the 2. I have some divergence in the 1. 15 minutes. See, when you have to hunt for divergences, it's not such a good sign, but we have it here. I will say that a majority of my reason was one of my guests that I have on. He's excellent. Had him on last week. Steve Anton was talking about this level. And so, you know, I tie it in with thinking the 50-day may hold in the S&Ps and a reflex rally and giving crude a shot here. I don't think this is, even if we get a good rally, I don't think this is the bottom, but I think it would surprise people if we got back into this gap that we left Monday with the market selling off dramatically, and you also have some moving averages coming in at 53. So why can't we rally from around in this zone back to 53 or so and then finish this thing off sub 40, which is what I think we're going to do eventually, is take out the low here from December 2018. I was wrong about the dollar. I thought there'd be one more break in the euro, and there wasn't, but I was right about euro pound. I thought that euro pound actually would pull back while euro made one more low, looking for one more jiggle. But look, we're cracking through this trend line here. And when you think about it, while the euro is making new lows, EG never did. So that was my narrative. And now we're breaking out over this level. Looks to me like 87. I think I had, oh yeah, it was Jeff York. His pivot point came in around 87. I think that has destiny in euro pound. Yen, I know everyone's writing it off here. I still think that this level right here, I mean, the 110 is a big round number, but I'm watching this moving average here at 109.60. My initial targets on all of the interest rate futures, which included when we were in the 130s in TLT new highs, back in here from this triangle that I showed for weeks upon weeks here in phase, favoring an upside breakout. And then looking for 135 in the 10-year, which were surpassed. And then I saw some other counts, I think including Grega's. We were supposed to have a bounce first before we headed to 110 30-year. Okay, so again, this is part of the panic. And even the leadership, look at Microsoft hanging on to the 50-day moving average here. And this one confirmed the high. It was one of the strongest stocks all the way up, along with Apple. So the market's in trouble. And we'll see, a lot of people are going to make a big deal if we close under this 200-day. My bet is I think we'll hold it. And if that happens, I think we're going to get a counter trend bounce in crude. So even though the S&Ps are under pressure, okay, even though they're under pressure here, look at this on the 1 hour. We didn't confirm this low. We really didn't confirm this low. On the 4 hour, we're not making new lows in the RSI. It's really oversold. These aren't ideal readings. You really want to see divergences above 30, not 20. But even on a very short-term basis, the 1 hour is saying be careful with shorts here, and the 200-day coming in. I don't know why we wouldn't be able to rally back to, we got something going back to 3,200 was a big deal here. See this low, this low. So we'll see if that happens. And I want to make people aware that we don't just do webinars. We provide great technical information every day. And if you're not at your workstation every day, we have mobile apps, we have phone apps, we push out notices, alerts when something's going on. It'll go to your phone, it'll go to your tablet, whatever you're carrying with you. If you're not at home monitoring the market, so you really don't even have to pay attention, because when some of these areas are breached, these support and resistance levels, you're going to get a notification. So that's a team working for you 24/6. Well, we even work Sunday putting together the week ahead video to prep you for the following week's trading. And really, one of the greatest advantages is not just the research, but working with the community. I'll let Blake show the Jumbotron, okay, because you're in there with people that are not doing this for entertainment reasons. They hunt to eat. So consider joining us. You could try it out. You could try for $1. You could get a 10-day trial, and that way you'll get all the features. And I think you'll get your dollar's worth. VIX above 30 now, yeah. How much is what? This to subscribe here? Is that what you're asking me? Here's our pricing. Okay. $119 a month, where you get everything. This is premium. Yeah, they are. Good reporting. I want to know what you were thinking 30 days ago. Okay, you get better deals. This is our best deal, the annual, David. Would love to have you become part of our community. That way, during the day, you have a question you want to ask Blake, pop right into the chat room. And if you don't know Blake, let me introduce him to you now. Blake, how are you today, buddy?
Hey, good morning, Coach.
Hey, bro. So some fear, and the president making a speech with a lot of people here. I guess there was some new corona development that's still pressuring things here, right?
Yeah, well, first of all, this is a very big issue in the markets, just overall. And here we are in the S&P, as you pointed out, we're at the 200-day moving average. I tweeted about it this morning. We're sitting here really close to some support, and the throwover area, the 618 retracement.
Yeah.
Actually, if you go back all the way back here, we're not at the 38% retracement. So we have the potential of even moving lower than where we're currently at right now.
And that's a breakout too, isn't it? Around 30 or so, Blake?
What's that?
A lot of people are going to say it's a retest of the breakout, that flat line that you have up
right
there
here,
on top.
yeah. Yeah,
around
yeah.
3,000, 30.
Yes, correct. That would be it's quite possible. And look, you guys got to be really careful here. First and foremost, bounces or short covering rallies can be very vicious if we get one. That's one. Two, I mean, we're at a very pivotal area. We could really just continue selling off here too. So it's not like this is a given at this moment that we're going to get some sort of bounce. I think it's actually quite opposite. We could get a continued sell off and a flush through the lows. But some of the things that this is a couple major things that I'm watching this morning. First and foremost is the euro. The euro is coming up to really key resistance. The euro, you can see here, it's moving. We've been talking about this bounce here. It's pretty vicious. We're at nearing the 618 retracement, big sell zone, right up against the trend line. Now, risk reward favors at this point in time to short into the strength. That would be the ideal, risk reward trade, is just to start selling up here. But if you guys missed the news this morning, Germany is going to be enacting a fiscal stimulus plan. It should be approved in a couple of days to fight the coronavirus. Now, if conditions continue to worsen, so let's talk about stocks again really quick. Let's say stocks continue to worsen. We continue to see a sell-off in equities. We continue to see the coronavirus stranglehold on the global economy. You've got an ECB that's basically they're not doing anything, right? They're not doing anything. Everybody's been waiting for German stimulus. So now you've got a situation where you've got a currency that's a carry trade, which is the euro. Which,
you know what, Blake? I want to tip my hat to you and acknowledge you that a lot of people didn't know which way the dollar would go under duress with risk off, and you pounded the table that the dollar would suffer under these conditions. A lot of people thought people might go to the dollar as a safe haven. Great analysis, man.
Thank you. I appreciate that. It's, it took a while to get any type of risk aversion, but you can see clearly the last several days of the stock market sell-off. We're talking 5 days of big selling. The euro has, reversed for 5 days, and it's been a very straight up reversal. So
you're not the pips are for nothing, man.
So this is the issue. If stocks continue to sell off, we're going to continue to see this rally in the euro, and this is a really good recipe for a continued rally in the euro at this point, because now you've got the ECB that is not doing anything. You've got traders covering up shorts. You've got you got German stimulus. You got a Fed that may start cutting rates soon. So now you've got a euro that's really fueled to rip in a big way. And so if you look at like the weekly chart of the euro, I mean, we pivoted right off of key, long-term support here. And I'll tell you what, I wouldn't want to be in the way of the euro if it really starts to squeeze. Now, if we get a bounce in equities today, that's a big if, right? If we get a bounce in equities, the question is, will the euro pull back? I believe it will, but when Dale was talking about a move to 22 or a 3,200. I'm sorry, 3,200 in the S&P. I think that is very optimistic. I think if we squeeze in equities, and you can see we're trading really heavy right now. If we squeeze, I would be really surprised if we make it much more than 31.20, 31.30. It could be sharp, but I wouldn't expect a whole lot. Now, if that happens, that means that the euro may pull back to 109.20, 109.40. And those, in my view, those are going to be opportunities to be a buyer of the euro dollar on any type of move lower like that. So just, we're in a very precarious and tricky situation right now. So you got to be real extra careful with what you're doing. The dollar yen, let's talk about the dollar yen for a little bit. Remember, there's been big official buying down here. We've had one of our traders, he happens to be in Florida at this time on vacation. He was talking to one of his friends at a bank and talking to his friends that are in Japan, and they're talking about the GPIF, which is the biggest pension fund in the world. Between them, farmers, post service, the Japanese postal service, everybody's buying the dollar yen down here at 110. So big official buying down here at 110. So yes, we are, pushing lower as equities move lower. But if equities bounce, then, we're going to get a bounce here. But how aggressive, I don't know, and the dollar yen's hard to read. But we are testing the big breakout trend line. This is a big, massive trend line that we broke out of last week. It's amazing that we're right back here at 110. So this is going to be a pretty tricky area for the dollar yen, obviously. One of the other things I think we should be looking at is also the US dollar Mexican peso. You guys have heard me screaming about the dollar Mexican peso coming out of this descending wedge when we were at 1870. And my thought the whole time has been that we're going to make it back to 1950, and we're not too far away from that. I'm pretty sure I mentioned this to you guys. One of my very good friends, his parents are Hispanic. They just sold a olive farm in the United States, and they're like, and they live part-time in the U.S., part-time in Mexico, and they were converting, since they were selling their farm, converting their money over to, from US dollars back over to pesos. I said, keep it in dollars for now. I think we're going to, I think we're going back above 19 and towards 1950 is what I told them. And once we get up there, you might be able to buy some pesos a little cheaper. And that's, it's basically, this is, you should see my text messages. This has been my text messages to the parents over the last few days, over the last few weeks. And here we are, at really key resistance. And this is going to be very important, I think, for the markets where we're currently at. We're up against the trend line. We're up against the 50% retracement, a 78% fib level, big confluence up here in the dollar Mexican peso. But the only way it's going to pull back, the only way we're going to get a pullback, towards 1930, 1920, is you're going to have to see a bounce in equities. And that's asking a lot right now. Now, one other point of topic I want to talk about really quick is end of month flows. We've had we've got end of month flows today and tomorrow, right? And, everybody's wondering, wow, is it going to be continued dollar selling into end of month, which was supposed to be right now? And then also, are we going to get some, equity market selling, which we had been expecting? The problem is with this big of a move lower, we are now thinking that you might get end of month buying because we've had such a big move down in equities. You might get some end of month buying coming in versus end of month selling. So just be careful of end of month flows coming through the next couple of days. All right. That's, I think, is going to be a risk near term for the market, is you're going to see some of these end of month flows come through. Speaking of which, I want to go back over to the dollar yen. Dollar yen just hit. Oh no, we're really close. You can see it right here. 109.76 is the 618 retracement. We just breached new lows, and we are looks like we're going to come down to this support. So just be very, very careful. Just be very careful here. So being on the short side, or if you're on the long side, you got to be careful too. These are very tricky areas in the market, obviously. Okay, So the euro is just kind of stationary. I got a question really quick. What about the Aussie? I'm not, other than the Aussie just trading heavy. I really have no, like, I'm not really focused on the Aussie as of right now. I'm not, it's put it this way. It's too oversold to be sold. But it's too weak to be bought. That's, you know, kind of my 2 cents regarding the excuse me 1 second really quick, regarding the sorry, I gotta do something. Here goes the dollar yen. All right, we're pushing. Watch for a reactionary level here. This might be an area where we get a little bit of reaction from the dollar yen, because this is right, like I said, this is the 618 retracement. So be careful being on the short side down here. We might actually get a bounce from this level. Also, I'm wondering if we're going to get a bounce here. If we get back over the 109.90, I'm a buyer. So that's because I want to see it pivot off of this support and then, start rallying. So that's what I'm looking for if we can get it.
That was an important pivot. If you go all the way
I think
back.
it is, but I want to
false breakdowns and false breakouts above it and beneath it over the last month or so.
Yeah, I think it's going to be really important to watch here down here. You just got to be real, obviously very careful with the market down here. I think it's a very pivotal area. I don't know if it's the right time to be a buyer, but I don't know if I'd want to sell into this weakness right now. But you look at equities are really close to their lows. We're right back at the 618, 30.60. Man, what a beat down here, And you look at currencies like, like I said, the dollar Mexican peso, I think you got to keep a real big eye on. I mean, we're just right back up again, which is still suggesting that this market is weak. You got to see a pullback in the dollar Mexican peso in order for me to be a believer that the stock market is actually starting to pull back here. That would be my 2 cents. The cable just ripped back above 129, but we're in this we're in this descending wedge. So you got to. This is very choppy waters in here. If you read this is, I do the end of day analysis and also intraday analysis, obviously, with the rest of my team. But I do the end of day analysis. Last night. As I wrote, still very whippy price action while on the apex of the wedge. Support is below the 129 level, and resistance just above 130 level near term. And you can see that the cable, we dip below 129, and then we pop right back up again. It's very whippy price action around here. So just again, be very careful with what you're doing regarding the cable. I was long some pound New Zealand overnight, got stopped out. Fortunately, I got stopped out a long time ago. But I knew it was whippy. I was surprised it actually dipped a little bit lower. I thought we were going to head higher than lower first, but it is what it is. There was one last thing I was going to talk about, Dale, before I turn. A couple of you guys have asked about ForexAnalytix. So let me just show you guys something. This is our chat room, and you want to see how active our chat room is. This is all of the chatting, and you can see I haven't even chatted in probably about half an hour. I mean, you just go back and back and back. Earlier, you can see we're all posting charts, and you can actually go back through here. You can go to the files list, and you can see all the charts that we've been talking about and what we're mentioning regarding them. And this is all about the markets. This is where you'll find me all day long. And you have to be a premium subscriber with ForexAnalytix to be part of the chat room. But while you're trying out ForexAnalytix, while you're trying us out, and not only with the mobile app and all the desktop application that we have, which is only $119 a month, but even if you go with the light version, while you're trying us out, you'll get the premium version, and you'll be able to jump in the chat room and see, if it's a right fit for you. So make sure you try us out. It's a pretty good deal for $1, just to give it a whirl. All right, guys. Well, I'm going to pass it over to my colleague, Steven Stelios. How are you guys doing this morning?
Good morning.
Very busy day. What do you think about this Euro move?
Well, we were talking about it, right? We were saying
nice quiz.
that the only scenario I saw for Euro strength was, apart from a short-term relief rally, is if there was a fiscal stimulus from Germany. So, just them talking about it is bringing higher. So do I think this move has legs? Yeah, probably a little bit. I think the Eurozone is still in deep trouble. But I wouldn't want to be short here. That's
like you guys have heard me say it. Look, under a risk-off scenario, the euro could very easily trade back towards 115, and it's not like the fundamentals in Europe have changed, and it won't stop a big liquidation of the market, right?
And Blake, I've been more or less saying the same. I've actually been saying for a long time here that, listen, the euro is in a downtrend. There's no question about it. But I don't want to participate in this downtrend, because I think that the bigger risk, if we're talking about an eventual big move, is not anymore to the downside. So I don't want to be in the wrong side of the market.
Yeah. And I think that's the right call. So, and I know you guys probably heard what I was saying about the German stimulus to fight the coronavirus. You put German stimulus, you put in risk aversion, which it fuels the euro buying from a carry trade standpoint. Then on top of that, you factor in a Fed that's probably they've got room to cut now. ECB is just going to keep rates at zero. They're going to let the German Bundesbank stimulate the economy a little bit, and so they're just going to keep rates where they're at. So now you've got a Fed that's going to cut probably if things worsen, and then a euro that's got all sort of carry trade issues, stimulus issues. I mean, we could really end up squeezing higher in the euro, way past this 112 resistance, if equities continue to weaken. And that is what we're faced with right now. So you got to be real careful with the euro at current levels. I haven't bought it yet. Although, you guys remember I was buying the euro Canadian last week.
And that and Euro MXN, I was looking at both of them today. They've really gone vertical.
Yeah, I mean, I sold the euro Canadian as we hit 144 and change. Two days ago, right here, 144 50 or something. Look where we're at right now. We're almost at the 200-day moving average. These euro crosses. Look at the euro New Zealand. Look at the euro Aussie. These euro crosses are mega bullish right now. So just be very careful with what you're doing with the euro.
We also talked, Blake, about yields not falling as fast in Germany as they have been here.
That's because they're negative, right? Everywhere.
Right, exactly. Hey, just real quick, we have GDP coming out. This is going to be backward looking, but just a little heads up. I am going to pass it over to you guys. I've got to get back over to the markets. But good luck today. Thanks, everybody, for being here. And I'm going to pass it over to Steve and Stelios. So you guys have a good one. Thanks, guys.
Thank you very much.
Good hunting, Blake.
Okay, let's have a look at the numbers first, and then we can have a chat. So we have GDP, durable goods.
20 seconds.
Durable goods.
Expected 2.1. U.S. initial jobless claims, which I doubt they're going to move the market unless it's a huge outlier. Expected at 212.
Oh, the numbers are early. Some are out already.
Durable goods
are good. It's better than expected.
Better than negative, but still a lot better than expected.
GDP 2.1 as expected.
Yeah, so non-event. I mean,
Yeah.
GDP and initial jobless claims, a non-event.
Yeah, yeah. I've been thinking about the dollar. It's really weird because if you look at the dollar index, not DXY, if you look at the US dollar index,
Yeah, but
remember,
since you mentioned it, Stelio, look
yes,
at the area the DXY got rejected from. We were talking about this
yes,
last week, that it was, at a key resistance, and that worked beautifully so far. So
yeah,
another rejection, and I stick to my point that I've been making for a long time, which is the exact opposite from the euro, meaning the DXY is in an uptrend. There is no question about it. But, this momentum is almost non-existent here. So, I don't want to be in the long side of the euro, of the dollar, like broadly. I mean, I have no problem like being long some dollar against some pair. For example, I'm going to show later that USD CAD seems to be breaking out. So USD CAD looks like, rather bullish. But, in general, I don't want to have like broad long dollar exposure. That's my point of view.
Germany confirmed my poem about coronavirus.
Which one, Coach?
The
one?
poem, Corona,
Yeah.
Corona, fear that I'll own you. Born in a lab in China, spreading so I'll find you.
Be careful,
no one is safe, not even a king. Here's the key line. I'll be the excuse for everything. So it took coronavirus for the Germans to finally get off their butt and spend some money on infrastructure.
As I answered to somebody on Twitter, don't hold a big basket about it. I remind you that Germans, and good for them, remain one of the most fiscally responsible countries. And trust me, when this whole insanity, deficits don't matter, debts don't matter, etc., goes boom, because eventually it's going to go boom, because the basic laws of economics have never changed.
Yeah, and here's the greatest excuse for everything.
Will we be alive though when they go boom? That's a question.
I'm pretty sure we will, Stelio. I'm afraid we will, actually. If I might
the
say
year
like that.
2525, if man is still alive. Go ahead.
Yeah.
So, Stel, sorry to
interrupt
you.
Have a look at the US dollar chart. So
the one that's more broadly balanced.
Yeah,
mean,
show
right?
your yearly chart.
So go back to like 2018. So basically, remember when the Fed did about turn and going from projecting tightening, etc.
Yeah. Here, high
exactly.
there, which actually was a nice wedgie formation here. There it is.
Yes. And then we went to pricing's nothing, or maybe a slight chance of a cut. The dollar did nothing. Actually, it rallied a little bit. Now, over the past, few days, we've gone from pricing one cut to three cuts. Nearly three cuts. And again, the dollar is doing nothing. So the dollar is just baffling. It just doesn't, it doesn't do much.
Stelio, do you know what this brings to mind?
What?
Some type of a version of what we've experienced during the last couple of months with US stocks, meaning we started getting more and more risk parameters coming on the table having to do with stocks. Stocks kept ignoring them, and they kept moving higher by disregarding any negativity. I mean, be it Iran, be it upcoming US elections, being coronavirus, and everybody started believing that US stocks are absolutely, totally immune. And then within 5.5 days, they've retraced, whatever appreciation they had during a 3.5 month period. So I wouldn't be, and that is what I eventually expect the dollar to do. I mean, the dollar keeps moving higher. We're pricing in more cuts, and it still keeps moving higher, or it's not doing anything. The Fed, as you very well said, at the end of 2018, the market was pricing like 3 to 4 rate hikes, and quantitative tightening being on autopilot. Then within a few months, the market had to realize that not only quantitative tightening is not on autopilot, but they're actually stopping it and almost, immediately starting quantitative easing at, a much larger extent than we had seen in the past. And we had to go from expecting 4 rate hikes to actually getting 3 rate cuts, and dollar was still immune to all that. And I believe that at some point the dollar is going to run out of fuel. That doesn't mean it has to be now, right? And it's going to just, collapse. That's what I think the dollar is eventually going to do. That's why I don't want to be in the long side as a long-term thesis or broadly, because that's what I eventually expect to happen in the dollar.
I am with you on that. The question is that the dollar usually, when there's times of crisis, it does become a safe, in quotes, safe haven asset. So I remember in the 2008 crisis, it did get a big bid initially. So
yeah, actually the crisis saved the dollar, because I remind you that the dollar was suffering, greatly prior to that, right? I mean,
yeah.
Here it is. Just look at this bear market that actually ended back then. I mean, for people that don't remember, in 2002, the dollar index was at 120. And in 2008, the dollar was down at 70. So in essence, the great financial recession of 2008 spared the dollar after a 42% depreciation.
Yeah.
Now, is it going to be the exact same behavior in the next recession, during the next financial crisis? In my opinion, it depends, but I wouldn't consider it a certainty, because we've talked about that before. Among the Western, or you can call them the developed economies, the US has by far the worst fiscal position at the moment. I mean, they officially will be showing this year something like a 5% deficit, which in reality is going to be something like an 8 to 9% deficit, because they have what, if any company on the planet did, they would go to jail. They have what they call off-budget items. So for some reason, a huge part of the US budget is categorized as off-budget items. And although, of course, it increases the yearly debt, it doesn't show as part of the deficit, but of course it is deficit. It is extra spending that cannot be made from income. What is the income of any country? Taxes. So the actual deficit of the US this year is going to be something like between 8 and 9%. We know that as a rule of thumb, when you go into a recession, you get, just by economic stabilizers and taxes going down and claims going up, you get something like an immediate jump of 3 to 4% of the deficit. And I think that in this case, the rule of thumb, which is 3 to 4%, is going to prove to be low. And the reason I say it's going to prove to be low, because usually you get an increase of 3 to 4% deficit, but usually, almost always, you start from a much lower deficit. So 3 to 4% deficit, that is the rule of thumb, as a percentage, is a lot more than if applying the rule of thumb starting from an 8 to 9% deficit would be. But even if we take that into account, that means that the US is going to immediately jump to something like, best case scenario, 11 to 12% deficit, which I have no idea what can actually keep the faith of the market high in an economy that is running that kind of a deficit. So that leaves only one player on the table, which is fully and openly monetizing the whole debt. But the question is, what happens to the dollar when the actual only buyer, not the buyer of last resort, but the only buyer that's left is the Treasury? Personally, as I've said before, I don't see, good future for the dollar in the long term. Any way I look at it, good scenario, bad scenario, dollar's next big move, in my opinion, is lower.
Yeah, I agree, man. Absolutely.
So anyhow, let's go back to did we have anything else, Stelio, before we go to the charts? Because we have, finally, we have some healthy markets, some nice movements, some nice technical events to talk about.
Not really. Even if we did, the economic data is just irrelevant now, right?
Yeah, that's actually very true. That's actually very true. Yeah. We're now in the a rare, I mean, having to do with recent past, rare phase that probably the market is going to be moving more from any negative data than from any positive data, because, you know, we're in a short-term kind of panicky mode. Now, that doesn't mean it's going to last forever, but so far it doesn't look like it's abating. So having said that, and since Blake covered the euro, I don't have much to add to that. I was looking lower for the euro as long as it held below this resistance area, because it could have still got rejected and pushed one last time lower. And the reason I say one last time lower is because I was tracking at this descending channel, so I thought that the euro might make it, you know, closer to 107, or even if it took a little bit more time, towards to 1065, where we also had the 161.8% extension. But, you know, from the way it's squeezing higher today, you know, I'm starting to doubt that's going to be the case. Anyhow, in order for me to turn, you know, more bullish, I would want to see this channel being broken to the upside, and we're definitely some distance away from something like that happening. So it's not like I'm rushing to jump, being long the euro. I've remained very patient, not trading the euro for quite some time, and I've been vindicated, and I'll be more than happy to trade it, but only when it's actually breaking out to the upside. Now, the S&P, and that's quite a big development. The S&P has not only retraced within like a little bit more than 5 days, 3.5 months of price action, but it has now put a daily close yesterday below this ascending trend line support, which dates back to the end of 2018. So it's,
is that impulsive? Would you say, Steve? A little bit, kind of impulsive.
Yeah, I don't know.
All
Let
right.
me think. It took us 3.5 months to go there, and 5 days to retrace it.
Oh,
Yeah,
not really corrective. It's kind of a little
yeah.
bit impulsive, huh?
I mean, let me be honest. It can prove to be a corrective move, but
Yeah.
the fact that so far it's unfolding in an impulsive manner, what it tells me is that even if this is a correction,
Right.
after an initial rebound, I'm
Yeah.
definitely going to be looking for at least one more leg to the downside.
Yeah.
So that's what this tells me. Okay.
Got
now,
it.
if then that proves to be the end of a larger correction and we go to new highs, it's a different story. But undoubtedly, I'm going to be looking to short the first decent correction of this move lower. And, after another leg to the downside, we can then observe the structure and start
Great technical narrative. Very good technical narrative.
Start making assessments of, if that was impulsive, if that was just a strong corrective move lower, or whatever we have in hand. Yeah. Also, Dale, don't forget, because for me, I had been saying that on occasion. Do you remember how many times I've shown this pitchfork on the weekly?
I do. My butt hurts from all the times you've shown it.
Yeah, so you remember
poking me with that darn thing, Farmer Steve.
Yeah, you remember that I said that once we went above the 200% extension, that was like a big red signal to me there, because we had only reached that line once, and when we actually did that, we had like a sharp correction lower, and then when we kind of recovered to the 100% line, we had that corrective move lower, which was probably the sharpest one we've had during this this whole uptrend that started back in 2009.
I also think, Steve, along with this narrative for weeks, maybe even months, we've been talking about the message the VIX was giving us,
sending out. Yeah,
especially on the pullback to 14 after the initial break. That the glaring difference between lows was telling you something.
Speaking of which, I'm just realizing that there is a huge chance, a big chance so far, it's going to be huge tomorrow, that this is going to be the biggest down wake in 10 years.
10 years. Since the
financial crisis.
Wow.
Yeah, just look at this candle. It's by far the most massive bearish candle I can see on this chart during the whole uptrend. So go ahead, be my guest and try to be long against that candle. But, I'm not doing that.
Good point. So it's not a corrective. It's a little bit impulsive. All right.
Yeah, I mean, it doesn't look that healthy, right?
Yeah.
And a friend here is, Ben here is saying, look at the monthly as well. Yeah, no need to be a rocket scientist for me to realize without even looking at it.
So a
Ben,
big reversal
that's probably
month. It's going to be a key reversal month. Yeah.
Whoa.
Key reversal month.
This is a key reversal month, and it's the let me verify.
Look at that
Not
divergence.
one there, not there, not there, not here. Is this a key reversal? No, we didn't have a higher high. So this is the first key reversal month
since
during,
2009. Since the bottom.
So I mean, this is a horrific monthly candle.
No one was looking for Corona to be a black swan. Here we are.
Yeah, and I'll reiterate what I've been saying in the past. When a market is so overvalued like this one, there is always going to be some kind of a trigger, right? If it wasn't coronavirus this month, it could be Bernie Sanders gaining in popularity next month, or who knows what, you know what I mean?
It's going to find a reason.
Yeah, but the fact that the market is reacting so strongly like this one is because simply, first of all, valuations were beyond absurdity, right? And second of all, because risk reward was so much skewed that no matter how much you have the Fed on your back, there comes a point that nobody can do something to help you, go on forever. Because all the gimmicks and central planning and all that, of course they do work, and of course they manage to manipulate the markets, but nothing is, and nobody's omnipotent. Nothing
Let me
works
say
forever.
this: if there really is a plunge protection team, you guys need to report to your battle stations.
Yeah,
right
ASAP,
now,
and get a few
here.
Red Bulls, and get a few Red
right
Bulls.
here.
Yeah, you're gonna need them.
Oh yeah, Ben told you look at that. Yeah, Ben.
Ben has a good point. I mean, I hadn't looked at the monthly. I was certain that it was horrific, but I hadn't actually realized that it was the first key reversal, and we're talking about a mega.
Yeah, Ben's
key
like
reversal.
the Nostradamus of technical analysis.
Yeah, good eye, Ben. Good observation.
Nice one, Nostradamus.
Euro, by the way, squeezing. I mean, it's like going like nobody's business. It's squeezing higher. Okay, so let's go through some of the questions.
Crisis Investing by Doug Casey, written in 1970. Just, I would.
So Dale have switched to being a buyer of USD yen for the very reason you mentioned that yield targets have been hit. Gautam, thank you very much for making that point, because I did want to mention that yes, my initial target in the 10-year yields, which was this little area that we have almost two extensions confluencing, roughly at 125 to 128, has now been hit. So my downside target that I had since we broke through this triangle has now been met. That does not mean that
Greg had 110, Peter Goodburn at 110.
You know why? Because that's my next target, which is the 161.8% extension of that rebound. So yes, if we go through that, then the next target is at 1092. So yeah, you can say it 110. So yes, if we are to continue lower, 110 is the next downside target. And we also hit here at the 30-year yield, the 127% extension at 175. And if for some reason we continue lower from here, the next downside supporting the 30-year yields is at 157, the 161.8% extension of this rebound higher. Needless to say that in both cases, we're talking about historical all-time lows, right? Just, to put that in context. So yields are already in territory that has never been tested in the history of financial markets before.
Well, we have Peter Bookvar here in about 10 minutes, Steve. So what a great day to have Peter.
That's an excellent occasion, and I know that we also have David.
Tomorrow.
Brady tomorrow. So those of you that are here, stick around for both interviews. Both our guests, I can tell you, from a personal perspective, both the guests we have today and tomorrow, besides, being well known for a good reason, they are some of the rather few people that really understand both the markets and economics. And I'm more familiar with David. I mean, I can say it with more certainty with David. David, for example, does realize and completely understands and appreciates the value of real money, the value of real economics, Australian economics, etc. But that never has stopped him from playing the market in both ways, both sides. Okay, so he's a guy that has a very objective viewpoint having to do with trading, irrespective of his fundamental thesis, which is a given. So stick around for the interviews both today and tomorrow. You're really going to appreciate doing that. Now, having to do with crude obviously could not sustain itself given the fact that we have no relief, no respite from the sell-off. Having said that, crude has now entered my next downside area of support, anywhere between 46.20 and where we currently are is an area of interest to me. I mean, we've now fulfilled what I expected to be, the next target once we went through this bear flag. So, I would start being a little bit cautious here with crude. It has already suffered quite a lot during the past 4 days. I mean, within the last 4 trading days, it's lost more than 12%. So, obviously there's no risk reward for you to attempt to be short here. Gold holding up quite nicely. It hasn't reclaimed the highs. Now, let me be very honest here. I do think that there is a decent chance that gold has started a corrective move to the downside. The fact that we actually peaked, we spiked higher and then we reversed lower that day, in combination with the fact that the market is still moving lower, but gold is not catching up, is telling me that, if we get a relief rally from the markets, gold can actually produce a lower low from there. Anywhere between 1590 and 1610 is going to be a good area from which we can then continue to the upside. Alternatively, a more bullish scenario, probably the most bullish scenario I can see on this chart at the moment, would be just consolidating horizontal in some type of another triangle and then moving straight higher from there. So these are the two scenarios. Having said that, and despite in the short term being very, very careful here with gold, nothing has changed from the fact that I remain a long-term bull in gold. Nothing moves in a straight line. Of course, there are going to be corrections on the way, and we might have one here. So, I don't advocate that you should be buying gold here. In fact, if you're looking for a short-term trade, it might be worth attempting to be short here. For full disclosure, I wouldn't be doing that because gold, especially under circumstances like the one we've been experiencing during the past few days, might easily get some big line that will move it $30-40 to the upside. Okay, I doubt it, but it's not impossible. So I wouldn't want to be trading short term against my fundamental thesis and then something happening and telling myself, why the hell did you do that? I mean, you've been a bull for so long. I mean, why would you want to take the other side to make a few bucks lower? So, but that's my personal thesis. Now, silver obviously not as strong as gold. Having said that, yesterday I mentioned that the first area of support is at 1775, and that's where we've stalled. If we go through this area, then you should be looking for 1740 to provide support. Clearly, if you want to be bullish one of these two metals for the time being, gold is the place to be. So until proven otherwise, I don't think you should be long silver. If you want to be long one of the two metals, gold looks much healthier. Gold puts good way to play it. Yes, that's a good point, Ben, because at least you pay a premium in advance. You know what you're risking to lose, and even if you have some type of a headline that's going to make gold explode higher, at least you had already risked a specific amount. You write it off to begin with, and you don't have to worry how much the market might jump while you're asleep. So I agree with you. If you really want to play gold to the downside, probably doing it through buying out of the market puts is the best idea at the moment. What you call German stimulus is an easing of the tight debt limit called Black Zero, says Ingmar. Fin Minister Scholz faces strong opposition, Lagarde. So if that has the characteristic of fiscal support and encouragement to the economy, that's welcome. I love it. I agree 100% with you. As I said before, I wrote back on Twitter to somebody when they said that fiscal stimulus is coming. I said, keep your expectations very limited. The German government is fiscally extremely responsible. Same applies to the Bundesbank. And also the Germans are notorious for being people that don't react emotionally, very fast. If they are to do something like that, I'm pretty sure it will take them more time to think about it, plan it, etc. And that's why we're talking about a country that has been run to the ground twice during the past 100 years, and it's still one of the healthiest economies on the planet. What about Aussie USD? Now, my problem with Aussie USD, and I mentioned it yesterday as well, and Kiwi is undoubtedly they remain in a bear trend, right? There is no question about it. I mean, we've had, for example, in the Aussie, we've had since let's say, if we're talking shorter term, since January 2018, we've had only lower lows, okay? But on the other hand, I can't really find myself wanting to sell something that has been beaten down so much, right? So do I think it's anything but bearish? No, absolutely not. I think, the Aussie is still bearish. My next downside target is the 161.8% extension of the last rebound higher, which comes at 64.47. So let's say 64.50, 64.5 cents. But I can't possibly short it here. Where would I put my stop loss? Okay, so if you're asking if I would be trading it the other way, not yet, not in a not one chance in a million. But I wouldn't also be shorting it. I mean, the time and place to be shorting those were, for example, in the case of the Aussie, was there when we broke through that channel, or you had a second chance in the Aussie because we indicated that there's a head and shoulders formation back then when it broke through 68.5. So these were the two chances to short Aussie when the risk reward really made sense. Now, I can't possibly find myself shorting it here. It looks like euro before the surge or not. Not really, because the euro has had a much more orderly depreciation period of depreciation. Now, with the exception of that last phase, that last few days of sell-off that we had. So can the Aussie turn higher from here? Yeah, it absolutely can. But I will need to see a daily reversal that's going to be worth noting before I can tell to myself, okay, now let me go to a lower time frame and start looking for long opportunities. Okay, so, but it hasn't come yet to that. Okay, so I don't yet see the daily signal that will tell me, okay, start looking for a bottoming formation. USD MXN. Okay, now I mentioned before, and I want to go briefly through that, because we have the interview and you really should stick around to the interview. I don't want to bleed into the time that Peter has. First of all, USD CAD is breaking a multi month actually dates back to the end of December 2018 formation to the upside. So if there is one pair I'm bullish, the US dollar at the moment is USD CAD. So that's one thing to note here. And having to do with the USD MXN that you're asking, where is it? Here it is. So now, USD MXN started by building this descending wedge down here, but the most worrying part, if you're short, is that it has now broken back through this multi-year symmetrical triangle. So as long as any rebound would get rejected anywhere up to this confluence of the 200 daily moving averages and the 61.8, and also broken triangles trendline support that might act as resistance, you know, it looked nice and well for a continuation lower. But now that it's breaking back below this triangle, I'm starting to get very, very, very worried about the fate of the bears here, because I know that that was one of the most popular carry trades for those that were bullish risk. And after seeing the sharpness of this reversal and, you know, going back through the triangle, I think that USD MXN can end up squeezing a lot more to the upside than people might have initially thought, including myself. So I would be very, very careful here. Okay.
All right, thank you, Steve.
Thank you, Coach. I'm looking forward to hearing what Peter has to say, especially now that we've started having some interesting markets to talk about, right?
Yes, the man who coined the Fed is not data dependent; it's S&P.
S&P dependent, which I think that now more or less everybody accepts, right?
Yeah. Okay, Peter, I'm getting you set up here. Welcome back to Face. I think I made you a panelist. There you are. And I'm going to unmute you. Oh, unmute.
Hear me?
Welcome back, Peter. How are you?
Hello?
Hi,
Hey,
Peter.
thanks for
How are
having
you?
me.
Oh, what a week, huh, Peter? I mean, this is
Yeah,
something
what a
that,
week is right.
yeah. So, you know, we were showing the monthly candle on the S&Ps, Peter, and here you go. I mean, here's the daily. Now, I was looking for a correction, but even this type of decline surprised me, who was bearish looking for something like this. How about you? Did this type of waterfall decline all at once, compressed in time, or maybe this is what the market was set up for?
I think it was set up for it, but I actually think that finally, this is the type of, you know, if you're looking for a short-term bottom, and I emphasize short-term, this is the kind of opening you want. You want to really flush things out, and I wouldn't be surprised if today's opening was a short-term bottom. We've squeezed out certainly a lot of complacency that had been built up into the market over the last month, when the equity market thought that everything was contained, that word again, and while the bond market, at least the treasury market, was telling the world that no, it's not. But now that we're going to open around the 200-day moving average, and you usually like to see the opening flush, and then you can at least build a base to grow from. But I want to emphasize short term, because who knows what will happen past the short term.
Yeah, look at, I'm showing a monthly chart right here, Peter. We could go all the way back to when the last Great Recession ended in 09, and you don't see a candle like this anywhere.
Yeah.
For
So
years. I mean, this is pretty ominous looking. What do you think? The end of the bull market, or just another pause to refresh? I know that's what the bulls are hoping for.
well, I only in retrospect, you know, it's a bear market, but I do think that what was important here is that before we even heard of what the coronavirus was, the economic growth globally has been slowing. And while we did get a little optimistic boost upon the U.S.-China trade deal, I think that the continued decline in the U.S. 10-year, the very mediocre data overseas that was not going to be cured by the trade deal because we're still left with all the tariffs, that the coronavirus is a major body blow. And while it's more emotional hysteria than actual, health impact. The economic impact of irrational hysteria is real and painful. And I do think that this will sort of flame out in the next couple of months. So the real test will be what kind of economic rebound do we get after that, which we'll get a rebound. But if it's somewhat muted because the underlying trends of global growth is slowing anyway, I think that would be the most disappointing thing to people. And I think also investors are waking up to the fact that central banks, with the limited ability of rates to cut and money to print, has very little in tools to address what we're facing right now.
Yeah, we still have a little room, but maybe the bond market has already done that for the Fed, and all it is an official pronouncement when they cut. Peter, I was thinking about this. I saw you on CNBC this week where you were talking about now valuations matter. They didn't matter a week or two ago, and now they did, and you're talking about that. Everyone still thinks the Fed put is going to work in this environment. Maybe what we have is a rally into the Fed and a failing rally on Fed action, and that would be the first time people would experience, because they were so successful over all these years, and especially at the end of 2018, to where they gave us a one-year rally after Powell and Yellen and Bernanke saying kumbaya together. And maybe this is going to be the first time that the Fed will try and be potent and end up looking like the emperor has no clothes. What do you think?
Yeah, well, that was the experience of the last two rate cutting cycles.
Okay.
Greenspan fought tooth and nail the decline in tech stocks, but the NASDAQ still fell 80%.
Okay, you're talking 2000. Okay.
Yeah, and Bernanke, of course, did the same and fought tooth and nail and didn't stop what was to play out. So, yeah, that is most likely going to happen, is that the rate cuts will be proven to be impotent. And interestingly, this is a real test for Powell, because I don't know if you saw, but the Bank of Korea overnight was expected to cut interest rates by 25 basis points, and they did not, because they basically said that what we're facing here is a health crisis that a rate cut is not going to be able to address.
Yeah.
The person who really disappointed me today was Kevin Warsh, who I thought was a very rational, logical thinker of the Fed, appreciative of the limited powers and major misallocations that the Fed creates. And he's in the paper saying that a coordinated rate cut is what we need. And that's the answer to what ails us right now. I'm just amazed at the complete delusion of that thought from a guy who I thought was a different thinker than that.
Political pressure, perhaps, Peter. And I'm going through your website right here, and from your statement before, you think this is going to flame out. So I want to ask you a personal question. Are you preparing for the possibility of self-quarantine for you and your family?
Yeah, my wife was at the supermarket the last couple of days stocking up.
Okay.
We do have our masks, so
okay.
Yeah, I do think that it's only prudent.
You think it's a possibility here in the U.S. that we could have a medical lockdown of major cities?
I mean, I obviously, like everyone else, hope to God that we don't get there, but you never could say never. And
Right.
there's nothing wrong with stocking up the closet for a couple of weeks, just in case, because if nothing happens, you can always eat it anytime you want.
I would say that besides the stock market, that if this is the type of thing that can affect everything, right? It starts with the airplanes and the hotels and the travel industry, but how many people are going to be going to open houses this spring? And I see your article here about new home sales.
That's going to be the problem. I do think, and from stuff I've read and people I've heard from, there is the belief that the just like the flu sort of dies out come springtime, that this will will happen as well, but that remains to be seen. We just don't know, but I'm hopeful that is going to be the case. And yeah, but the economic impact is real. I think the health impact is, you can't discount it, and it's unfortunate people get afflicted, but if you look at H1N1 and you look at the swine flu and you look at other situations, and the mortality rates were much higher, and most people who get the coronavirus will be just fine. It's the same people that get afflicted by the flu and die from it. They're the most vulnerable, and it'll be the same situation here. But again, you can't, with the media and precautions and the extent of globalization and travel and tourism, this and that, the economic impact is real, while the health impact is relatively minor compared to other viruses in the past.
So here I am looking at historical lows in 10-year. I was looking for 135, and we're through it. Some people talking 110 on the 10-year your view. And could this end up being, I mean, we've been in a over a 30-year bull market in bonds, and I think we haven't had interest rates like this for hundreds of years. Could this be perhaps the last hurrah in the bond market? And could that be brought on if what the dollar is doing and what the euro is doing? If we're about to enter a bear market in the dollar, it's hard for me to see a continuation of a bull market in debt. What's your view?
Well, I think what follows this economic scare is going to be, I think, a major supply shock that's highly inflationary.
Okay.
That leads to a rise in yields, because when you think about, I mean, there are U.S. companies out there that can't get product in China that they originally sourced from, and they're trying to find a U.S.-based replacement. Well, they're paying 30% higher for that. When China comes back on, good luck getting a ship to bring your stuff over here, because there's a lot of people in line ahead of you. That the price increases we're going to see, because the flood of the demand that is now pent up relative to the ability of bringing this supply back online, which is going to take time, is you're going to see quite some serious spikes in the inflation numbers. So I'm not a belief that the 10-year yield falls that much further from here, which is obviously breaking below the summer 2016 lows after the Brexit vote.
Yes, so I mean, great time to be unloading bonds if you've owned them a long time. Yes.
Yeah, longer term ones, yes.
Go ahead, Steve.
If I may interrupt,
Go ahead.
Peter, first of all, I agree 100% with you, having to do with potential inflationary shock, which nobody's expecting, as you know better than anybody. And I've kept wondering about it. The Fed is not even stress testing for any type of scenario that we have a recession and increasing yields. I'm assuming they're not doing that because every single bank would fail. The question is, besides the short-term potential for an inflationary shock, do you also see the dangers of having again an incident of stagflation like in the 70s? The deflationists believe that is impossible due to the change of demographics. I'm not that sure about it. What do you think?
Well, the inflation shock I'm talking about is more of a cyclical thing. It's not it would just
no. I get it. I'm asking if you think that this can also be something more long lasting due to chickens coming back home to roost, after so many years of reckless monetary policy, etc.
I would say I don't know yet. I think it's possible, for the sole reason that services inflation has remained very sticky. Services inflation within CPI, mostly because of rents and healthcare, have been running 3% year over year for years. It's only the deflation or disinflation in goods prices that have kept things low. Now, services, of course, will include shipping and trucking and all the supply issues there. But on the good side, if you get a big rise, that's going to be inflation. Now, how long that lasts, I don't know. We're going to have to see how it plays out. But at least I know for a period of time, we're going to get some serious inflation surprises to the upside, that I think we'll look back on these yields and say, what were we thinking? But we've been saying what were we thinking for years now, particularly with negative interest rates. So I understand where yields are today because of that.
Okay, so we'll have the supply shock at Walmart. Right, Peter?
Yeah, I mean, it's going to be, imagine the rush and the demand to get products and to fill shelves. And if you're an auto company in the U.S. that uses a lot of parts out of China, I mean, it's going to take, the demand is going to come back strong, but it's still going to take time to fulfill those orders, and not just to fulfill them, but to actually procure shipping to get them over here.
Okay. Now this has really taken center stage, but Peter, we're only about 8 months away, 9 months away from a presidential election. Are you starting to add the ingredients of some political uncertainty about which way we go? And do you think that Sanders has it wrapped up? Or do you think that there's so much fracture in the Democratic Party? Could they even put up a contestant that's going to have a chance to dethrone Trump?
I mean, right now, well, I don't discount the possibility of a fractured convention, and who knows what comes.
Brokered, yeah.
Yeah.
Okay.
I think with respect to Sanders, you want to emotionally say he can't win, but in terms of the math, of the electoral college math, I just don't see a path for him in terms of the purple states won't vote for him. He would need to win Florida, and I don't see how he would in Florida. He'd probably lose Wisconsin, Michigan, which you need to win because unions don't want to be told that they're going to lose their health care and be replaced by government-run health care like Medicare. I think Pennsylvania and Ohio would be tough to win because he's anti-fracking. So I just don't see the math path for him to win, even if he does become the nominee. Now, if he does become the nominee, I'm sure the markets will freak out this summer, and everyone will look at polling numbers and say, wow, he's head to head. But I just don't see how the math works in his favor in terms of the electoral map situation.
Okay, and I know you've been a long time and early on investor in precious metals. They've been performing well. Just a pause to refresh in the gold. The only argument I could come up with, especially if the dollar is turning down, that could break gold would be, you think it's possible one of the biggest buyers of gold has been China over the years, and if the yuan continues to crater, that they could dump some of their central bank holdings on the market?
I don't believe so. I think China has a long-term plan to continue to grow those holdings. So
Okay.
I don't think that'll be the case.
Can you come up with anything that could put a chink in the armor of precious metals with everything that's going on? I mean, you can't think of a better perfect storm for metals here, can you?
Yeah, I trust me. I think all the time what could negatively impact the story, but after a long-term bear market that we saw in gold and certainly in silver. I mean, silver's down still 70% from its highs. I mean, name me one asset that's down 70% from its all-time high. There really aren't many.
Good point.
I think there's still a long runway ahead for them, and that the factors that would end a bull market in the metals is still well out into the future.
And would that be the only thing that could probably do it would be having someone like the great liquidator at the Fed, like Volcker, and higher interest rates, whether it's designed higher yields?
Yeah, it'd be higher real rates.
Okay.
But that's certainly not out there anytime soon, because just as I mentioned, if we're going to start to see an inflation rise, well, real rates will go even lower.
Okay. I know you liked some of the overseas markets when you didn't like U.S. How are those acting this week? I
mean, they're as badly as everything else, but I would honestly be buying Asian markets hand over fist. Okay, because I noticed on your
website, and there has been a day or two where we've been under tremendous pressure, and actually China wasn't. I think you have an
Yeah, well,
article
look
about.
at last night, the 8-share index, and I like it to look at the 8 shares because the 8 shares in China are could be manipulated by the government. But the 8 shares
Right.
which trade in Hong Kong and the Hang Seng index both actually closed up last night. Now, whether that's a sign that they think that China, while the first to get it and
Here it is.
created the spread of the virus, maybe they're the first to contain it, and now the rest of us have to deal with the spread. Maybe, maybe not, but I thought that that was interesting. And while those markets are down this week, and they're certainly down a lot year to date, that they actually traded okay this week tells me that maybe the market is thinking that the rest of the world has bigger problems, and that China actually, with their dramatic steps in quarantine, is actually closer to containing it right now.
Okay. Crude oil under pressure, so just part of the slowdown story, Peter.
Yeah, all part of the same trade.
Okay. And banks have they really didn't perform that well when the market was doing okay. So as long as yields are heading down, avoid banks. Any areas in the market that would be perhaps your first place where you might be looking in carnage to pick up?
The best,
Oils?
most attractive group, in my opinion, that's going to see the largest snapback at some point are going to be everything travel related, because
Okay.
that's something that bounces right back, whether it's
Like
the cruise
airlines.
lines, the airlines, the casino stocks. They're going to bounce back rather sharply. There's certainly a lot of pain, and I'm not sure when this pain ends, but there's going to be quite a trade there. And actually, I've been recently buying Royal Dutch with its 8% dividend yield.
Okay, Peter, anything you want to wrap it with today, partner?
I would repeat what you said earlier, is that valuations don't matter until they do, and now they matter. So just pay attention to valuations which have gotten excessive, whether it's in corporate credit, whether it's in pockets of the equity market, and understand that this virus will pass, life will get back to normal, but we could be entering a slower growth period where excessive valuations are not going to cut it anymore.
Okay, and how about subscribing to the book report and show me my membership option. So if you want to follow Peter, here are some of the prices. Look pretty reasonable to me to have Peter's analysis at your fingertips here. So thank you for edifying our community again, Peter, my trading
Thank you,
warrior
Dale.
brother. Yeah,
Appreciate
good
the
luck to
invite.
you and your family. Stay safe and
You too.
clean up in the markets, okay?
Yep, thank you. You as well.
All right, thank you, everyone.
Thanks,
That's
bye-bye.
Peter Bookfar. You could see him on CNBC. You could follow him on Twitter at pbookfar. And that'll be a wrap for us today. Good luck out there, everyone. Remember, there's this thing called gravity that's taking place in the market. So don't try and catch a falling knife. I've tried it, and I'm actually trying it again. So you can't break bad habits. And most of all, everyone, don't just count your pips, count your blessings. And we'll see everyone tomorrow. Wrap it up. David Brady will be with us. Thanks again, Peter.